They can't stop the bank runs. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the bank runs will get worse as all attempts to plug the liquidity hole in the banking system are outright failing. And we're seeing policymakers become increasingly desperate to get this crisis under containment before it spreads out to even more banks and causes a complete lack of confidence in the system and a massive crash in the financial system. And yet, every attempt that they've made hasn't worked at all. And the key reason, what I really want you to understand, is that they don't actually know what the problem is, and that's why they can't solve it. We're going to look at what their latest attempt to get this crisis under control is and why it won't work. Plus, I'm going to show you why the banks themselves are actually causing part of the problem that they're trying to get the answer to. And we've got a major announcement coming from the FOMC tomorrow, and I'm going to give you my take on what I think the Fed's about to do. Let's head over to Fox Business, where we start with a headline. Regional community banks rally to call for FDIC backup. So I want to step back a little bit because we've got now some more color on this issue, but I want to step back to a piece of yesterday's show and then dig deeper into what the banks are begging government to do and why this will have absolutely no effect at solving this crisis. The FDIC ordinarily insures deposits up to a cap of $250,000 per depositor, with least balances in excess being vulnerable in event of a bank's failure. And in recent response to the collapse of Silicon Valley Bank and Signature Bank, federal regulators granted systemic risk exceptions and guaranteed all deposits to those banks. And then we heard, of course, the Treasury Department has signaled that regulators aren't planning to backstop uninsured deposits at banks that aren't granted systemic risk exceptions. And of course, we heard this from the Treasury after President Biden came out and said, hey, look, your deposits are safe. Everything's going to be fine. And well, as it turns out, the president doesn't have that authority. And now it's turning out that the Treasury doesn't have that authority. And so what this is now telling the public is if you have money at a small or mid-sized bank in excess of the guarantees, your money may not be safe if your bank goes under. And now all of a sudden you see the reaction is people are going to move their money because they're worried. And it may make sense for Congress, who is the one who could actually do something here, to look at the insurance limit cap, and we'll get into that a little deeper, and revisit raising it on the metrics demonstrating increasing deposit balances since the previous increase. But the tone coming from the Treasury of picking winners and losers defies logic and is largely inappropriate. If the FDIC decides to provide unlimited deposit insurance to some institutions, even on a limited basis, they can't discriminate and leave other institutions out, because again, the answer here is simple. Government's saying, hey, you're systemic, you're not. And all of a sudden you can tell money's going to leave those not institutions over to other institutions where depositors feel they're safe. And again, this is a major misstep by policymakers, but I want you to see is nobody really has the authority to do this except Congress. And as we all know, Congress is never in a rush to do anything, but we'll talk more about them a little bit later. Senator James Lankford noted he could make smaller banks less attractive destination for depositors. Somebody who gets it with funds above the $250,000 threshold. He said it sounded as though Yellen has encouraged anyone who has a large deposit at a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole. What Yellen responded is, that's certainly not something we're encouraging, but yet you can look at the actions, right? We can hear what policymakers are telling us, but the actions of the Treasury Secretary are indeed encouraging that, as Senator Lankford suggested. And that's what we're seeing here. So if their attempt to actually put a stop to this flow of money out of the small and mid-sized banks was the notion that certain banks will be systemic, others won't, well, that's not actually going to work. So that's one of the reasons we're seeing this continue. And now we're going to dig deeper and hear from Yellen, who's kind of realizing that she made a huge mistake. Yellen says we will intervene if needed to protect smaller banks after recently saying we wouldn't. Our intervention was necessary to protect the broader U.S. banking system, which there's no evidence to show, and similar actions could be warranted if smaller institutions suffer deposit runs that pose a risk of contagion. Now, key words there, pose the risk of contagion. So if some small bank in some nowhere place has a run on deposits and maybe they only have a small number of branches, pose no broader risk to the financial system, well, what she's saying is, well, they're not systemic, they're not causing contagion, we're probably not going to cover them. So again, key is to listen to what she's saying and see that they're not doing what we actually need them to do. This coming from some experts of a scheduled conference on Tuesday. Today, the federal government delivered just that, decisive and forceful actions to strengthen the public confidence in the U.S. banking system and protect the American economy, she will say. Now, I'm going to ask you this, and you can vote in the comments what your take is. Did the government give you confidence in your banks, in the system, in the fact that you think your money will indeed be there tomorrow if something were to happen in your banks? Because in my book, I don't think they've done anything to give Americans confidence at all. In fact, when you have a problem and every solution you come up with doesn't work, and you're on round 4 or 5 of trying to plug something that's leaking, it tells everyone, you don't know what the problem is, and you certainly don't know how to fix it. That step, she added, will reduce the further risk of bank failures that would have imposed losses on the FDIC. Well, I'm not sure about that because, as we pointed out, again, there's other problems here. One of them is the Fed is directly competing with the banking system. So here you see, we've talked about this before, overnight reverse repurchase agreements sitting at $2.1 trillion. This is federally backed money market funds that are out there in the market. The Fed is paying over 4% on this money. It's currently paying 4.55 less the haircut to the money market funds than paying that to people who have their money parked there. So if you have an issue where the small and mid-sized banks are facing a massive flow out of money, and some of it's going to the Fed at the tune of $2.1 trillion, what I want to suggest to you, my friends, is there is one solution that might actually work, is if the Fed got out of the business of backing money markets and put that overnight reverse repurchase rate back to zero, or maybe even negative. Say, hey, you can put your money here, we will back it, but it's going to cost you. You could watch that $2.1 trillion. Yes, it would flow out, and some of it to the mega banks, but you better believe a bunch of it would go back to those small and mid-sized banks who are in desperate need of cash. And on top of that, we have the money supply. We talked about that in the other show, is recently that it's negative, and this is highly unusual. So not only are we seeing the Fed compete in the money market space, but in terms of money in the financial system, it's contracting. And again, this is something that shouldn't normally happen. But what I want you to understand is, in our financial system, in a reserve-based system, or what I mean is a fractional reserve-based system, there's always more debt than there is money. So if you think back to the pandemic, what happened? There was a whole lot of government spending, and during that time, people did not have to pay on all their debts. We had this huge run-up in the economy. Now what are we seeing? People have to pay on those bills, particularly on all that debt, and now the economy is slowing down. So what you need is a further expansion of credit, the creation of new money, not only to support economic growth, which is key, but to pay on all that debt. And that's why a little bit later, I'm going to show you how the banks are part of the problem that they're looking to the government to solve. And here comes the answer from the government. It must be, the problem is that there's no confidence in the system as U.S. studies ways to ensure all bank deposits if the crisis grows by potentially expanding FDIC coverage. And I don't know about you, but I don't think that that actually is going to give anybody confidence. The idea that, hey, don't worry, your bank could fail. You'll get your money, but we won't tell you when or how. And in the meantime, well, the bank failed and perhaps your money is lost. But the idea that you're telling people, look, if we raise this limit, it'll give you a whole lot of confidence. I don't think that that's the case at all, because the average American isn't probably sitting on $250,000 in cash in one bank. It doesn't seem likely, even though I know there's people out there that do. The Treasury Department staff are reviewing whether federal regulators have enough emergency authority to temporarily insure deposits greater than the $250,000 cap. So notably here, I want you to see they're reviewing to see if they have emergency authority. So what the Treasury is saying is, we don't have the ability to do this. That's handled by Congress, but maybe somewhere in some law, somewhere there's a sentence or a few words that we think is a gray area that would allow us to do this, and that's what they haven't found yet. And without formal consent from a deeply divided Congress. So now let's get into Congress here and see what they're talking about. Because authorities don't yet view such a move as necessary. Now, what you want you to understand about Congress is, because a lot of people say, why don't they act faster? Why aren't they doing this? Why don't they do that? Because they were never intended to do that. So if you think about what Congress is created to do, it isn't react to instantaneous problems. That's what other parts of the government is designed to do. So from the perspective of Congress right now, what happened? We had a little bit of a banking crisis. The Fed, the Treasury, the FDIC, the Federal Home Loan Corporation, everybody stepped in and did what their departments and organizations were designed to do. And for the moment, again, I'm not suggesting this is over, but for the moment, it appears to be contained. And from Congress's perspective, well, hey, there's not much of a problem, but we've got a whole lot of things to talk about and probably no action that we'll actually take. Especially after regulators took steps this month to help the banks keep up with any demand for withdrawals, asking not to be named, of course, the source, so they're developing a strategy out of due diligence in case the situation worsens. This is exactly, as I said, what Congress would do, but perhaps there's some of them that don't actually think this problem is worth their attention or that they need to do anything because it won't look good. While some lawmakers, including Republicans, have said they are weighing the changes to the $250,000 FDIC cap, a number of House conservatives have come out 100% against such guarantee. Any universal guarantee on all bank deposits, whether implicit or explicit, enshrines a dangerous precedent that simply encourages future irresponsible behavior to be paid for by those not involved who follow the rules. Boy, I'd love to get your take on that. What do you think? Should we have an implicit or explicit guarantee on all deposits? Or is the reason we're seeing this problem now is because some banks were taking the wrong amount of risk, and that they should be allowed to be penalized, and depositors need to be more educated on where they put their money. But now let's shift gears and talk about this upcoming FOMC meeting. It started today. We'll get an announcement tomorrow from the Fed. And of course, the expectations now are that perhaps they won't hike, but I want to show you why I don't think that's the case at all. I think they're going to continue to raise the funds rate. Federal Reserve faces tough decision on rate increases. This piece from Nick Timmerus of the Wall Street Journal. He says it's going to be a tough decision with very tricky communications. This from a former senior Fed economist who is the professor at the Yale School of Management. And no, it's not going to be a tough decision, even though economists at Goldman Sachs estimate tightening in lending standards. Wait a minute here. Tightening in lending standards, which is something we've covered on the show. Now let's look at this a little deeper, and I want to show you a chart here, and then you're going to see just how the banks are causing some of their problems. In a sense, it may not be anything that they can control. Again, economists at Goldman Sachs estimate a tightening in lending standards due to the industry stress would be equivalent to a quarter or half a point increase in the federal funds benchmark rate. And here we can see the net percentage of commercial industrial banks tightening lending standards, and we can see it is at levels now that is consistent with recessions and other financial crises or other bad things. And so in a sense, you start to look at the problem here is that banks are tightening lending standards, which means they're lending less money, which, as I mentioned earlier, is there's less money being created in the economy. But one of the challenges here is a lot of loans are originated from the small and mid-sized banks. And if they are seeing their deposits flow out, guess what they now can't do? They can't lend. They can't shed those treasury securities they bought because they're upside down. They can't unload them. It's a problem that isn't going away, my friends. And banking's now you're seeing the banks are actually part of the problem. But does this mean the Fed actually pauses here? I'll tell you why I don't think so, and neither does a former Fed official. I would advise them to go ahead with a 25 basis point increase. If they pause, you can get into this. What do they know that we don't know? Bingo. This from Richard Clarida, who was a Fed vice chair from 2018 to 2022. If the banking crisis passes more quickly, a decision to pause rate rises risk worsening the inflation problem by igniting a market rally that is counterproductivity eases financial conditions. The issue with not hiking is the market will price in a cut at the very next meeting. And that is exactly it. The Fed's going to look at this and say, hey, we've been raising the funds rate and doing what we're doing to bring inflation down. We don't regulate those small and mid-sized banks. It's not our job to keep track of what they're doing because our banks in our system are A-OK and they've got it right. If the Fed pauses here, it tells the world that perhaps they know something that we don't know. The Fed's going to say, not our problem, but inflation is, they're going to keep hiking, maybe just not as much as everyone thought. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.